retirement in the UK. Now, since 2015, there's been a change in legislation that you can actually, from the age of 55, assess your pension plan. So that is, you can maybe choose to retire and assess your pension from the age of 55. But this age is set to, there's a plan to rise to 57 in April 2028. So if you are planning to retire early, maybe at 55, and you are not retiring until after 2028, begin to think about it, that you might not actually be able to access your pension plan until 57 or 58 if the law changes as well. But it is possible for you to be able to, withdraw your money before the age of 55 currently, if you have ill health or if you have less than 1 year to live. Maybe for people that have been given a diagnosis that they need to, that they've been told that they cannot live more than 1 year, so they can access their pension plan and withdraw the fund there. Now, that's the summary of retirement in the UK in terms of the age and when you can actually retire. So let's consider and discuss what we will call retirement planning. Okay, or let's look at what we call your pension. So your pension is a fund into which a sum of money is added during your employment years, and out of this pension you can then draw out when you are retired. Okay, so when you consider a pension is just a fund of money that you, or a pot, or is whatever, a plan that you add some money into when you are actively working, and such that when you are done working, you can then draw out of the money that you have put together in your pension, in that pension plan. Okay, so that is the general or the simplified definition of pension. Now, there are different types of pension, but before we look into that, the first question that comes to mind, which we will try to use a bit of question and answer this morning, is a pension really worth it? With the cost of living crisis at the moment, and a lot of people are opting out of their pension in order for them to have some extra money at their disposal. So the question is a pension really worth it? Should you have a pension and pay in 5%, 3%, or even 10% of your income into it? The simple answer to that is yes, it is still worth it. And why do we say so? The key benefit of you having that pension is the income tax relief that you get, or when you pay into a pension. So essentially, you usually pay into your pension from your gross salary. Okay, and whenever you are taxed, you will be taxed on what is left after you have paid into your pension. So that means, in real sense, if you pay 80 pounds into or if you pay 100 pounds into your pension, it's really costing you 80 pounds because of the tax relief. So the remaining 20 pounds is being added by the government. So let me say that again. If you pay 100 pounds into your pension, assuming you are a basic rate taxpayer, it's actually costing you around 80 pounds, because the remaining 20 pounds is what the government add into your pension in the form of a tax relief. So you pay your tax on your post pension contribution salary. So that's your net salary and not your gross salary. And because you are able to do this, it means that your tax bracket, the amount of tax you paid is reduced, because you have paid certain amount into your pension already. So think of it: if you have 100 pounds into into your pension as a basic rate taxpayer, it's actually costing you only 80 pounds. The remaining 20 pounds is being added by the government, and this is true for every form of pension that you can consider. Okay, so let's look at the other possible benefit of a pension very quickly. So the other possible benefit of a pension is that you have the opportunity for your contribution to grow tax-free. So whatever contribution you have in your pension, it's allowed to grow tax-free. So it means it can compound. So for example, giving the example of the £100 that we used previously, your £100 in your pension can grow tax-free. That is, it can continue to grow without you paying any tax, maybe until the end when you're about to withdraw your pension. And this might look too simple, but if you think about it, if you invest or put in £80 in your pension over 30 years, the amount you get at the end of 30 years will be different from if you put £100 into your pension over 30 years. So rather than you paying only 80% into your pension, you are getting 100% into it. So what you are actually investing is not 80%, but 100%, which can still grow tax-free. So any growth in your £100, maybe 50% growth, is not taxed within the pension pot. And that makes it very, very good, because if you are being taxed regularly on your investment on a yearly basis, then what should be accumulating or compounding is significantly also being reduced by the tax liability there. So pension is good in the sense that you get tax relief at source or when you are paid, but at the same time, whatever you put into your pension also grow tax free. So at the end of the day, you have a lot of money compounding compared to if you are being taxed from on the income or the growth of your investment. The last point, which is also very important, is that if you are an employee, that is, if you are employed by someone or you have an employer, for example, your employer by law is also expected to contribute a certain percentage into your pension pot. So I think for many people, by law minimum is you pay 5% in, your employer pays 3% in. Now, some people will not enroll in the pension. If they don't enroll in the pension, the 3% that the employer is meant to pay in will not be paid in. So it means that you are leaving money on the table. So what they are saying is give 5% and get 8%, which very interestingly sounds too good to be true, but that's part of the perk or the benefit of having a pension. You put 5% in, your employer put another 3% in, and that gives 8% that is being invested within your pension plan. So if you are not taking that 8% or the 3% from your employer, at least by law, by the barest minimum, you are leaving money on the table and your gross remuneration is lower than your peers. So being a member of the pension plan means that you are actually getting a full package that you are being employed on. It is costed that you are being employed on that gross remuneration. But if you are not taking it, then you are definitely underpaying yourself. And the interesting thing is, even though I mentioned that by law the barest minimum for employers is around 3%, there are pension schemes that the employers pay in as high as 20%. So if you are not paying, if you are not joining, it means that you are leaving 20% of what you should be getting on the table. Even though you are not accessing it now, it is in a place waiting for you in the future. Okay, so that answers the question, is a pension really worth it? But again, if you have any question of your own as I'm talking, please post in the chat and then we can look into it there. Okay, so there are four basic types of UK pensions. The first one is what we call the UK state pension. The other type is the defined benefit pension. We have also the defined contribution pension. And lastly, we have the self-invested personal pension, or SIPPs. So we will look at each of these pensions very quickly, and then we can proceed to the next discussion. So if you look at the state pension is what you receive when you approach the official, or when you reach the official government retirement age. Now, there is an official government retirement age. Currently, it is 66 years of age in the UK, and this is said to be increasing to 67 in 2029 and 68 in 2037. So there is a plan for us, at least from some of us on this call, to work further up to 68 in the future before we can officially retire. You know, but the idea here is, if you have paid your national insurance contribution, as if you look at your payslip, you should see national insurance contribution. If you have paid it in full or for at least 35 years, then you can get the full state pension. The full state pension as at today, 2023, is around £203 per week. And if you put that together in a year, it's around £10,600 a year for one person. So if you are a couple, you'll be expecting around £21,200 a year for a couple. And don't forget, this is at age 68 or age 67 or age 66, as the case may be. These people would have been expected not to have, significant debt or significant outgoing at that particular age. So that is your state pension at age 66, that you get that kind sum of money. And the good thing about state pension is that currently the government has what they call the triple lock, in which your state pension is guaranteed to increase at least by inflation, or the highest of the, in terms of, there are three ways they compute this. They use either a minimum of maybe 2.5%, the current wage growth percentage, and they use also the inflation figure. So they use the highest of these three. So in the last September, inflation is around 10 point something percent. So the state pension for 2024 will increase by around 10% to around 11,000. So if you look at it, that is what you get when you are at age 66 and you have paid into this, you have your national insurance contribution for up to 35 years, full. And if you do that, you can get the full state pension. Now, it is possible for you to get some, but not the full, if you have at least 10 years of national insurance contribution. Now, I know people who worked in the UK for some years, they've gone back to Nigeria, and they are still receiving the UK state pension in Nigeria, for example. All they have to do is sometimes, maybe on a yearly basis, I think, go to the embassy and just indicate that they are still alive and they are being paid, straight into their bank account in Nigeria. So if you have worked for at least 10 years in the UK, then you are sure that you will get some state benefits or state pension when you retire, at least as of today. The truth is, the policy can change in the future, but as of 2023, that is the case. So if you then think about it, how can you make sure you are having the national insurance contribution? For some people, you might not be working, maybe you're on maternity leave, for example, and if you are entitled to maternity allowance, for example, then you will get credit for you get the national insurance credit. So if you are not working and you are maybe a carer for UK citizens or UK permanent residents, then you can get some national insurance credit that can serve as an alternative to national insurance contribution. So even if you are not working, you can still get full state pension because you have some credits that have been added against your national insurance number. Now, for some people, when you get to age 66, for example, you might say you don't need the money now. You want to defer the pension. You can defer it. And if you defer it, it means when you are ready to receive it, maybe at age 70, your state pension would have increased, because when you defer it, there is an increase that's automatically added in terms of percentage to what you ought to earn because you have deferred it. Okay, so that's about state pension. The other pension that we'll consider very quickly is the defined benefit pension. This is often or sometimes called the final salary scheme. Although the final salary scheme is no longer available, most of the defined benefit pension now is where you are paid a certain amount of money based on how many years you have worked for your employer and the salary you have earned. So when you look at the details of defined benefit pension, you begin to see what they call the accrual rate and so on and so forth. So what this means is basically you contribute, your employer contributes into the same pension scheme with the assurance that when you retire, you'll be paid a certain amount of money. Okay, so here you don't have a pension pot, but what you get at the end is an assurance, like a defined benefit, that when you retire, we will pay you certain amount of money, lump sum, depending on how long you have worked, depending on your salary as well. We'll pay you this amount lump sum, and on a monthly basis or on a yearly basis, we will pay you so and so amount of money. So whatever you are paying into your defined benefit pension is like it's like a subscription rather that you subscribe to, that at the end of your working life, you get some dividend out of that subscription. So it's not like you have a pot of money that is with your name on it in a defined benefit scheme. Now, for the defined benefit scheme, usually if you are a member of the scheme and you die, you have what we call the life assurance within the scheme, such that your spouse, your civil partner, your dependents will be given a certain amount of money on a monthly basis as though you have retired. So it has its benefit. And if an individual who is a member dies, for example, they can also get a life assurance, a certain fixed amount of money that is paid to their family. So that's like a life insurance within the pension plan as well. Now, some of the examples of current, defined benefit pensions are teachers' pensions and USS, that's for the university, NHS pension, and even the local government pension as well. They are example of existing defined benefit pension. So you don't have a pot of money with your name on, but you are sure that at the end when you retire, you get a certain amount of money. Now, the other type of pension is the defined contribution pension. This is also called your money purchase pension. Here, you have a certain pot of money with your name on it. So you can log into your pension account, you see how much you have in your pension pot. So the defined contribution pension is you contribute, your employer contributes into the pot, and that pot is invested. Now, whether the investment does well or not, your pension provider in most cases manages it, but you can choose to take over and manage it yourself. But again, the idea with the defined contribution is it is only your contribution that is defined. The benefit you get at the end is not defined. So you might invest and the investment goes bad and you don't get a lot of money at retirement. So there is a risk that is attached with the different pension scheme. For the defined benefit, your employer basically take the risk by law that if anything goes wrong, they come in to provide that support. With the defined contribution scheme, you take the risk on your own. So that is why it's very good for you to have an understanding of what it is invested in and how best to manage your investment, such that when you are growing your wealth, you know where your money is invested and you know what to do as you approach retirement as well. And so at the end of the day, you can choose when you retire what to do with the money. And we'll look into that down the line to just talk about what you can do with the money that you have in your defined contribution pension pot. The last type of pension is called the self-invested personal pension, which is what we call the DIY pension. So here you are able to have a pension pot in your name. You are able to choose the type of investment that you want. You are able to choose the provider, and you have control essentially over the pension. Now, if you compare this with the defined contribution pension, they are very similar in the sense that you put money in, but one of the difference is there is no employer paying into your self-invested personal pension, and at the same time, you have the control to choose what to invest in within that pension pot. Okay, now there are so many things or laws that comes to regulate your self-invested personal pension. But one of the things is if you die or if the person who has this self-invested pension personal pension dies before their retirement age, then it is possible that the money you have in your pension automatically pass to your beneficiaries. And that is why I would say this very quickly. If you have a pension, make sure that you have set who your beneficiaries are. Praise, praise God. Now, for your beneficiaries, it could be your wife or your spouse, it could be your children. Make sure you set it before as soon as possible. And for some people, you can actually say, okay, well, if you die at the end, 50% should go to your wife, 25% to go to your children. So if you have 5 children, you can then decide to give to them 5%, whatever the distribution, it will allow you to enter it there. And for many pension, you can do this online. So make sure you log in, check who is entitled to your pension. It doesn't mean the money is lost, but if it is not claimed, then it goes to the crown. So if you don't want to work and the people that should benefit from your from your money or for your labor are suffering because they are not aware or because you have not set it up correctly. So at the end of this webinar, if you have an access to your online pension account, or if you're watching this video, go in, check who your beneficiaries are, set it up, give the right proportion as you deem fit currently. Now, if you have 2 children or 3 children and then you have one more child, you can also go back, change things around to account for that newborn. So it is very important to do this, otherwise your family might end up struggling if you are no longer there, whereas you have already have enough investment that could have taken care of them. But if you have not done the right thing, the paperwork correctly, then your family might be suffering needlessly. Okay, so with the self-investment personal pension, you can choose to open it with any of the providers like Vanguard, like Fidelity, and so on. So there are several providers out there, and just to say, we have not been paid to mention this name. So you have options when you retire to take off your pension from your self-invested personal pension. Please look at the blueprint, the fine print and the terms and conditions to know how to take it out. But essentially, if the person who has a self-invested personal pension or SIPP dies before age 75, then your beneficiaries can receive your old pension fund tax-free. So if you have 100,000 there, they can get the 100,000 tax-free. But if that person dies after age 75, as at 2023, then they can take out, the cash at one go, but it can be subject to tax, or they can take out regular income from that pot, and they can also take out periodic lump sum, maybe 25% every now and then from the pot. That's if the owner dies after age 75. Okay, so there are so many considerations for this. However, you can, when you are opening the SIPP, they will provide you that information. So please make sure you read before you say you agree. Okay, so the next question that comes to mind is, how safe is my pension? You're working very hard, but is your pension safe? And I can say, according to the current regulation by the UK Financial Services Compensation Scheme, your pension pot or fund is protected up to £85,000 per provider. So if you have pension with Nest, if you have pension with Now Pension, Scottish Widow, you are protected up to £85,000 per provider. Okay, and this is to cover any loss if the company or the pension provider goes into administration. But if you lose money because of your investment, it is not covered. So you need to be very mindful of this as well. Okay, so but then up to 85,000, you are covered per financial institution. And then you need to be sure and check this very carefully. If you are banking with a particular bank and your pension is with the same bank or the banking group, make sure you check if your savings with the bank is protected up to 85,000 and you have a separate 85,000 for your pension. because in some cases, because it's the same group, you're only protected up to 85,000 for everything. So if you have more than 85,000, you can lose out at the end. So always look at the fine print. I know it's very easy to say than to do, or just signing an agreement, oh, just scroll through, accept. But there are so many things there that you need to be aware of. Otherwise, when things go wrong, you will be surprised that they say, sorry, we cannot do anything because you have already agreed that this is the way it is. So you need to be very mindful of that. Now, what other options do you have? You know, can you also use your lifetime ISA for pension? You know, sometimes ago we were talking about in the past videos, we're talking about lifetime ISA. You can use your lifetime ISA for your pension. And here, if you put £1 in, if you put £4 in, government gives you £1, so 25% on every contribution. And this can be used for buying your first house if you are below the age of 40, or that's when you can open it, but you can use it up to 50. If you are below the age of 40, you can open one, use it for buying your first house, but every £4 you put in, government gives you 25% on top of that. And you can use it for pension as well. So if you are employed, if you have an employer, it might be best to stay with your employer scheme using auto enrollment rather than you using the lifetime ISA. But if you are a self-employed person without a pension plan, then the lifetime ISA can be good in the sense that you get 25% on top of your contribution from the government, which also can serve as your employer's contribution. So if you are self-employed, I would strongly recommend or suggest that you consider the lifetime ISA. Okay, so that's it about the lifetime ISA. Now, when you retire or at retirement, what can you do with your defined contribution, your DC, and your SIPPs? So if you have a DC pension or your SIPP pension, what can you do with it? Now, in the past, you can only buy annuity with your pension pot. But now there is a freedom since 2015 that you can do more with your pension fund. Number one, you can, if you have a pot of money within your defined contribution or SIPP pension, the first thing you can one of the options you have is that you can take out all your money at once. Here, if you have £100,000 in your pension pot, you can take it all at once, but only the first 25% is tax-free. Only the first 25% is tax-free. Then the remaining 70% will be taxed as income. So if you have £100,000 in your pension pot, your defined contribution or your SIPP, if you take 100,000 out, you can only get 25%. That's 25,000 tax-free. The remaining 75,000 or 75% will be taxed, maybe as a basic rate taxpayer and so on. So you need to be very mindful of that. But once you get to this point at retirement, it is very important that you talk to a qualified independent financial advisor. That's one option. So we will look at the next option. So for the next option is your pot of money is there for you to use. However, you can then choose to do certain things with it. Number one, out of this second option, is that you're not taking out all your money at once. Instead, you decide to maybe take out only 25% that is tax-free every time. So in every tax year, in 2023, you can take out 25%. Next tax year, take another 25% out. Next tax year, take another 25% out, and continue until the pot of money is exhausted. In this case, you won't pay tax, but you are living on 25% at every tax year. Of course, if you take out 25% of your pot every year, what that means is you have only 4 years to take it out. So you have to think about it. How much do you want to take out in your pension that will be enough for you to live, but at the same time you will not exhaust it before you die. So there's a balance there as well. Then the other option is to take a 25% tax-free at start, then buy what we call the flexible income drawdown product. Here, you can take 25% out, the remaining 75%, Buy a product that remain invested and continues to grow and until you are ready to take another 25% out of it. So rather than having your 75% in cash, you can take out a product that invests the remaining 75% with the hope that by the time you are ready to take out another money, that 75% has grew to 80% and so on. So as you are taking it out, there is the possibility of it growing again. There is also a risk with every investment that you get less than you put in. So you have to check and balance what is your risk appetite at the end of the day. Then the last option, which is kind of a bit of risk free, is that you can take 25% tax free at first, and then you buy what we call the annuity. And the annuity gives you a guaranteed income every year for the rest of your life. So you take 25% tax free, and then you buy a product that gives you a fixed income for the rest of your life. And the problem with the fixed income with the annuity is once you die, maybe 1 year after retirement, the money belongs to the company. It's no longer, it cannot be passed on to your children or your beneficiary. So the benefit they get is in the 25% or in the amount you get on a yearly basis that they can live with. So there is always a balance here, but talk to a financial advisor when you get to that stage.